The retail market is currently executing a fundamental mispricing of Broadcom. They're staring at a localized geopolitical sell-off and mistakenly applying legacy hardware multiples to an exponential custom silicon monopoly. The stock has bled out over the last 2 weeks, but balance sheets do not bleed. They compound. Welcome to part 2 of our GreenCandle forensic audit. In part 1, we mapped the physical thermodynamics of Broadcom's gigawatt-scale ASIC chokehold today. We mapped the math. We are tearing down the Q1 2026 earnings reverse engineering a algorithmic panic and defining the exact structural arbitrage windows this volatility just opened. On March 4th, Broadcom shattered consensus. Non-GAAP EPS printed $2.05, cleanly beating the $2.03 consensus. But that headline is completely irrelevant. The forensic reality is the sheer velocity of their artificial intelligence segment violently offsetting legacy cyclicality. Q1 AI semiconductor revenue hit $8.4 billion, surging 106% year-over-year, meaning custom AI silicon now single-handedly dictates 67% of their total semiconductor revenue. But the true engine of this quarter was the VMware operating expense slaughter. Management ruthlessly gutted bloated legacy costs, slashing the quarterly run rate by over $1.5 billion. When you pair high-margin AI hardware with that level of extreme cost discipline, you engineer a staggering $13.13 billion in adjusted EBITDA. Competitors are hemorrhaging cash to build fabs. Broadcom is printing it at a sustained 68% margin. The market trades on future execution, and CEO Hock Tan just broke legacy financial modeling management guided Q2 total revenue to $22 billion, a 47% year-over-year surge that obliterated street estimates, with AI semiconductor revenue officially guided to hit $10.7 billion next quarter. That is a violent 140% growth acceleration. But the most critical metric in the entire report is the pipeline. Hock Tan confirmed they are secured to deliver $100 billion in AI chip revenue by 2027. This proves, definitively, that the hyperscale transition from general-purpose GPU training to custom ASIC inference, driven by the OpenAI Titan and Google Ironwood programs, is not stalling. It is going vertical. Management team's live balance sheets do not. Broadcom generated $8.01 billion in free cash flow this quarter, mechanically converting 41 cents of every dollar directly into pure cash. They immediately deployed this cash to pay down $3 billion of the VMware debt, transferring enterprise value from debt holders directly to equity holders, while issuing $3.1 billion in cash dividends. That 65-cent per share payout creates a concrete institutional yield floor. Finally, they executed $7.8 billion in repurchases to artificially constrain supply, culminating in the absolute a brand new $10 billion buyback authorized on March 4th. You do not burn $10 billion on your old equity unless your hyperscaler pipeline is demonstrably ironclad. Value investors balk at Broadcom's 31x forward PE, completely ignoring the underlying math. That earnings denominator is artificially compressed by VMware acquisition amortization. When you factor in the blended top-line growth and the massive 106% AI acceleration, Broadcom's price to earnings to growth ratio violently compresses to 0.87. Look at the peer matrix. Marvel struggles with sub 40% margins to gain ASIC share, while Nvidia commands peak cycle multiples. Broadcom captures the exact same gigawatt scale data center spend, but at a severe structural discount. To validate this, We run a reverse discounted cash flow model against their $100 billion 2027 guidance. If we assume that $8.01 billion quarterly free cash flow scales linearly with their guided 47% revenue acceleration, the terminal value mathematically dictates severe upside targets far beyond the current trading range. Following earnings, Broadcom blasted to an intraday high of $343.51 before suffering a brutal algorithmic distribution, closing today, Friday, March 20th, at $310.51. This late-stage fade is driven by pure macro noise. Surging U.S. Treasury yields, algorithmic de-risking tied to kinetic Middle East conflict, and an EU antitrust complaint. The geopolitical shock is a temporary liquidity vacuum Broadcom's core. AI physical supply chain is locked in with TSMC and domestic Texas expansion. That does not change the physical reality that OpenAI still needs 1 gigawatt of custom silicon by 2027. Furthermore, the EU antitrust complaint is a regulatory smokescreen, the proxy war backed by AWS and Azure, to block Broadcom's private cloud consolidation. Legally handling the closed, operationally integrated $69 billion merger is practically impossible, and even maximum regulatory fines will not break a 68% EBITDA margin. The ultimate anchor for this valuation is the secular revolt against Nvidia's pricing power. Hyperscalers are mathematically forced to transition to specialized ASICs to escape 75% gross margins, and Broadcom is the undisputed, inescapable architect of that gigawatt-scale hardware transition. GreenCandle provides architectural forensics, not financial advice, so map your own risk. If macro conditions break or sustained, EU penalties delay build-outs. Our bear target is $275. If 3.5D packaging becomes the exclusive hyperscale standard, the bull target is $500, but our base target remains $470. We respect the technical reality. The stock sliced right through the massive institutional point of control between $325 and $335, hitting an intraday low of $309.92. You were catching a falling knife driven by regulatory fear. Hello. This divergence between accelerating AI hardware fundamentals and macro-driven price deceleration has compressed Broadcom's PE-Q ratio down to roughly 0.82, acquiring an inescapable tech monopoly, growing its AI revenue at 140% at a discount to its growth rate is a structural arbitrage opportunity. The absolute ripcord is $307. A daily close below that invalidates the sit-up. But as long as that floor holds, you do not buy technology monopolies when the market is euphoric. You accumulate them when algorithmic panic creates a mathematical discount on guaranteed cash flows.